The next topic we talked about earlier is understanding the numbers. Rob Hughes is going to be talking us through this section. So Rob Hughes is the director with Pitcher Partners, specialising in the retail pharmacy industry. Pitcher Partners have a very large portfolio of business owners and can provide great insight into pharmacy trends and benchmarks. So please remember to keep your questions coming through via the chat, and I'll now hand over to Rob Hughes.
Thanks very much, Chris, and good evening all. Here at Pitcher Partners, as Chris mentioned, we're specialists in pharmacy accounting. We handle anything from your general compliance work through to management type work, which includes valuations and due diligences. We also assist with budgeting and cash flows for financing applications. And we also specialise in strategic type projects, customer retail trends, pricing, merchandising, etc. Just a quick little bit of housekeeping just to notify you that anything in my slides tonight is just for discussion purposes only and doesn't constitute any personal advice. So this evening, I'll be running through 5 key aspects regarding knowing the numbers when you're looking at purchasing a pharmacy. We'll go through the financial statements, talk about understanding the profit and loss and the balance sheet. We'll go through key performance indicators, what they are and how they're calculated. We'll look at valuations, what's the pharmacy worth, and we'll go through the due diligence process, and we'll have a quick look at financial forecasts. Now, given the amount of time that we have available, I could spend an hour on each one of those topics. So it's just going to be a really high-level overview just to introduce you to some of these terms so you know what to look for and not to keep an eye out for and dive deeper into as required. So if we start with the financial statements, you'll spend a lot of time on the profit and loss statement. Now, the profit and loss statement is a summary of the revenue and the expenses of the pharmacy over a specific period of time. Now, generally, they'll be prepared in financial years from July to June. But if you're looking, say, purchasing a pharmacy in the second half of the financial year, you probably will then look at management accounts up until a month or two prior to where you're actually at during the financial year. So the main sections of the profit and loss is the trading statement, which goes through all of the sales, the cost of goods sold, and the gross profit being produced by the pharmacy. Then there's the other income, which generally consists of your PPI income, any allowances, commissions, any service-based type stuff. Then you've got your operating expenses, namely your wages, rent, advertising, and then your non-operating expenses, which is your interest, amortization, legal fees. So just to show you a quick example of what a pharmacy profit and loss statement may look like, here is the trading statement section of the profit and loss. As you can see here, we've split out the dispensary sales and gross profit from the retail sales and gross profit. It really then gives you the ability to look at each section of the business on their own, rather than it all being lumped together. And generally, we'll see profit and loss statements come through and they might split out the dispensary and the retail sales, but then the cost of goods sold and the gross profit is all mixed into one. If you can split it out, it's worth your time in doing so because it then gives you a greater ability to have a look at some more KPIs on the business. Moving on from the trading statement, the next part is the other income of the pharmacy. And this is all of the service type income or any income that's not actually related to selling a product. For example, your PPI income from your 7 CPA, being your DAAs, home medicine reviews, etc. Also things like the cash flow boosts that came through in the last couple of financial years will be recorded here. Then comes all of the expenses, so all of the operating expenses required to run the pharmacy. Namely, the 2 main expenses are going to be the employee costs, being the wages and superannuation, and also the rent. And we'll look soon at some KPIs around how to review and benchmark those expenses. Finally, after your operating profit comes then any non-operating type expenses, being your interest, legal fees. Then obviously your income less the expenses results in either a net profit or net loss for the year. Now, the other financial statement that accompanies the profit and loss statement is the balance sheet. Now, more often than not, you won't receive a copy of a vendor's balance sheet when you're looking at purchasing their pharmacy. Now, the reason being is the balance sheet is specific and personal to the vendor. You know, it has their liabilities on there, which shows their debt position. It may also show the goodwill, so it gives an indication on what they actually purchased the business for. So, but what is relevant from a balance sheet for you as a purchaser is namely the employee entitlement. So that's, if you're going to take on any of the employees of the business, what entitlements in the way of superannuation, annual leave, long service leave is owing to them. And Nick will actually cover a little bit more detail of that later on. Just how a balance sheet works, your assets is the sum of your liabilities and your equity. And the equity is really what profits are left in the entity that haven't been paid out to the owner. So a quick example of what a pharmacy balance sheet may look like. You see there's the assets on the one side and then your liabilities and your equity on the other side. And obviously being a balance sheet, they balance nicely. Before we move on to the key performance indicators, have we got any questions on that, Chris?
Yes, I do actually. I have one question in regards to your average split. So between all the businesses that you see, what's the average split between dispensary and OTC?
It's generally around 70-30, but it depends. It can be as high as, say Ian said, 85%, and it can be as low as 30%. On average, we see about 70-30, but yeah, it depends on what type of pharmacy it is. If you say you're a price line in a CBD mall, for instance, your front of shop turnover is going to be a lot higher than your dispensary. But say if you're, sorry.
Yeah, no, go, keep going.
But say if you're a medical centre type pharmacy, generally you're going to have quite a high dispensary sales.
I think the question is probably more like a community strip. What do you think average
community strip
would be?
Yeah, you're probably going to be looking around that 70-30 split.
Yeah. Okay. And then the other question I had was in relation to how you separate sales and purchases into dispensary and retail.
Okay, yes, that takes a little bit of skill and reviewing a few different reports. So if we make your dispensary sales is generally quite easy to get. You can get that off your script analysis report. That's quite an accurate figure. Depending on what type of dispense system that the pharmacy uses, you can then also get the gross profit, the dispensary gross profit off that same report. Then the balance of your sales becomes your retail sales, and the balance of your purchases and gross profit becomes your retail. Where you can't rely on the dispensary report for your gross profit, you then need to look at, say, a department sales report or profit analysis report, and have a look at what the retail percentage of your gross margin is. And then you'll balance your retail sales to that, and then whatever's left then goes to the dispensary. So it takes a little bit of tweaking, but when you get it right, you know it looks right. But sometimes, if you don't get it right, it'll look really wrong, if you know what I mean.
Okay. All right. That were the questions on that one. So continue on.
Okay, thanks. So after you've reviewed the profit and loss statement, you then want to have a look at some of the key performance indicators, or KPIs. KPIs are quantifiable measurements that we use to gauge a business or a pharmacy's performance. Now, The KPIs can be based off financial data, like the sales, gross profit, wages, rent, all those things that we've got there on the profit and loss. But we can also use some non-financial data as well. So things like customer numbers, script volume, the number of items the pharmacy sold during the year, the size of the pharmacy, and you look at the size of the dispensary and the size of the front of shop separately. You also have a look at the number of staff and the number of hours that they've worked as well. So just to run through a few examples of some common KPIs. First one being the gross profit margin, which most people are quite familiar with. It's referenced straight back directly to the profit and loss statement, and it's calculated using the gross profit divided by the sales. Now, where I've mentioned sales here, it's going to be your sales excluding the value of your high-cost drugs. We classify any of those drugs where the cost into store is greater than $5,000. We classify those as high-cost drugs. It's generally your Hep C type drugs, and a lot of those were introduced in around 2016, 2017. So we see the average gross profit margin for the industry based off our averages, which is around 200 to 300 pharmacies in our cohort. And we see the average sitting at around 34 to 38%. Now, I just want to point out that our averages, they depend on the type and the location of the pharmacy. So you may have a discounter pharmacy and its gross profit margin is probably going to be lower than 34%. Or you may have a rural type pharmacy with little competition around, and they might have a gross profit margin around 40%. So it's going to vary, but on average, it's around 34 to 38%. Another income KPI to look at is the gross profit dollars generated per script. Now, that's calculated using the dispensary gross profit divided by the total number of scripts dispensed during the year. Now, it's a measure and it may highlight any pricing issues that you have in the dispensary, and it may highlight opportunities where you can increase your pricing on your private and the co-pay scripts. So we're seeing at the moment the average is around $12.50 to $13.50. The next KPI to look at, and that we do look at, is the PPI income generated per script. Now, that's calculated by taking the total PPI income from the profit and loss statement and dividing that again by the total number of scripts dispensed. Why we look at that as a measure to the total scripts is because generally pharmacies with generally with scripts become opportunities for that service type income. So pharmacies with a higher number of scripts, we'd expect them to have a higher level of PPI income. Our average at the moment is around 50 cents to 70 cents per script. Now, looking at your expenses, generally the pharmacy's greatest operating expense is going to be the wages. And we like to measure the wages in a number of ways, but one way is to measure the wages as a percentage of the gross profit dollars plus the service income produced by the pharmacy. Now, we see the average around 40 to 45%. Another really important measure is the rent to the sales. Now, this is taken by simply taking the total rent off the profit and loss statement, taking that as a percentage of the total sales. Now, average is anywhere from around 3% to 7%. We do see lower than 3%, especially in those rural type locations. And we've certainly seen higher than 7%. You might be looking at some major shopping centres, CBD type locations. But on average, it's around 3 to 7%. It's a really important one to get right because generally when you enter into a lease, you're locked in for a number of years. You could be locked in for 5, 10 years. So if the level of rent, if the sales don't support the amount of rent that you're paying, you'll struggle to make a good profit. And it's also, you need to have a look at what increases are in that lease as well, and what your sales will need to increase going forward to justify the rent. Another measure to look at when you're looking at the rent is what the retail sales generated per square metre are. So that is then when you take the retail sales and you divide that by the front shop area. And what that gives you is an amount. Our average range is between 5,000 to 7,000. So what that means is, if you take the average of $6,000, it means for every 1 square metre of the front shop area, $6,000 is generated in sales over the year. Now, what this may highlight then, if it's well below the averages, it may be, okay, well, there's too much space available. The sales aren't supporting the amount of space that's in the front of the shop. And then that may then be reflected back into a poor rent to sales ratio as well. On the other side, if it's well above the average, it may be that the pharmacy, the front of shop's too small, and there's reason to justify to try and make that bigger or move to a new location. Another to look at is the overheads to sales. So this then takes into account all of the operating expenses as a percentage of the total sales. And we see the average of that at around 25 to 28%. Now, looking at the return as a whole on the investment in the pharmacy, if you look at the EBITDA to sales, which is your earnings before interest, tax, depreciation, and amortization. And we look at that as a percentage of the total sales. And on average, it's somewhere between 9 and 11%. Lastly, another good measure to have a look at is the average retail sale per customer, which is taken as the total retail sales divided by the total number of customers served during the year. And we see the average around 14 to 16%. It's a good measure to look at to see, okay, if it's well below average, it may mean that there's opportunity there to really work on the retail side of the business. That's it for KPIs.
There's a couple of questions on the KPIs. It actually might be good if you could just go back. Yeah, that's perfect. Yep. Keep that slide up. So what should the GP percentage owners of pharmacies be targeting?
Well, it really depends on what type of pharmacy that you want to be. If you set yourself out to be a discount pharmacy and you're going to compete on price and volume, then your target gross profit margin is going to be on the lower end. It may even be lower than 34%. But on general, if you're aiming for 36, 38% for a run-of-the-mill community pharmacy, then it's a good target.
In relation to your KPI, the fourth line down with the wages to GP dollars, so why do you use the percentage of GP dollars and not total sales for that?
We started using GP dollars when the high-cost drugs were introduced in 2016, 2017. Because what we found is that the high-cost drugs were skewing that ratio, and not all the data that we were getting was pulling out those high-cost drugs. So we thought, well, the high-cost drugs don't actually have a great impact on the gross profit dollars, because a pharmacy may have $500,000 in high-cost drug sales, but the cost of that is near $500,000 as well, and there's only a small amount of gross profit. So the gross profit is still relative to the rest of the gross profit in the store. So it just gives a more accurate measure, and you don't have to worry about adjusting for those high-cost drugs.
So if you weren't using that measure and you were using it as a percentage, if you didn't have access, for example, to the high-cost drugs sales, what do you think the average wages as percentage to sales ratio should be?
It's generally, we're seeing our averages is 14 to 16% as a percentage of sales, and that's excluding high-cost drugs.
And are you seeing wages increasing or decreasing as a percentage of turnover?
Maybe decreasing ever so slightly, but wages in pharmacy have been flat for a number of years now.
Okay, thank you. Just one more in relation to this question's in relation to greenfield pharmacies. So the question is it best to use 5% rent to determine the potential turnover in sales as a calculation?
Well, yeah, 5% is around our average. What's going to be the hard part there for a greenfield site is accurately measuring or estimating what the sales are going to be. But yeah, if you can achieve 5% of sales, especially achieve that early on in a greenfield site, it will be good.
Okay. Thanks, Rob. I think that were the questions on the KPIs topic. So let's move into valuations.
Okay, so the next question, valuations. What is the pharmacy worth and how is that calculated? So fair market value is defined as the price that will be negotiated in an open unrestricted market between a knowledgeable, willing, but not anxious buyer and a knowledgeable, willing, but not anxious seller acting at arm's length. But as Ian alluded to before, it's a bit of an imperfect market out there at the moment in that there's more buyers than sellers, which may create some anxiety on the side of the buyer, just wanting to get their foot in the door and wanting to get into the market. And that has an effect on the price that they're willing to pay. Now, when we look at the value of a pharmacy, we're looking at the enterprise value of the business. And as Jack said, that's comprised of the stock, the property, plant, and equipment, and the goodwill. Now, we know what the stock and the plant and equipment are because we can see the stock on the shelves. You can see the actual shelves as part of the plant and equipment. You can see any computers, they might have a robot, etc. But the goodwill is an intangible asset that you can't see. And I'll just divulge on that in a little bit on what goodwill actually is. And lastly, when we talk about value, the enterprise value, it's not to be mistaken with the equity value. So we're looking at the value of the business, not the value of the entity that owns the business. Because more often than not, you're going to be purchasing the business of that entity or that person, not purchasing that entity. So what is goodwill? So goodwill is the amount that seller might be expected to pay for the value of the business's intangible assets. That may include established branding, a loyal customer base, having quality staff, the pharmacy having a competitive advantage, systems and processes, whether the pharmacy runs efficiently and effectively, the location of the pharmacy, whether it's in a nice convenient location, and also the lease, does it have a tenure there to keep operating in the foreseeable future? So if we have a quick look back at the pharmacy balance sheet, when we're talking about value, we're talking about the stock, the plant and equipment, and the goodwill. So in this example here, we're talking about a value of $1.5 million. That's not meant to be confused with the value of this entity itself, which would generally be defined as the net assets, being the $500,000. So there's three main ways to value a pharmacy, or three methods, I should say. One is a capitalization of maintainable earnings. Two is a discount cash flow approach. And three is the asset-based approach. Now, I'm only going to really go through the capitalization of earnings approach because one, it's the most common method that's used. And two, we simply just don't have time to go through the other two methods. So the capitalization of earnings approach is a function of the future maintainable earnings of the pharmacy, which is quite often referred to as the FME, and we'll come to what that is. And it's also a function of the capitalization rate, and we'll go through what a capitalization rate is and how it's determined. So when we look at the future maintainable earnings, the FME refers to a concept of what the business can maintain as its earnings on an ongoing basis. Now, to do that, we would firstly review the profit and loss statement, and then we adjust the net profit for any non-recurring abnormal income, any non-recurring costs, depreciation, or any profit and loss on disposal of assets is also ignored. The cost, any costs that aren't essential for running the pharmacy, Any costs and expenses there that are specific to the owner, and same thing with any income in there that's specific to the owner, that's ignored when we're looking at the future maintainable earnings. Really, the FME, it represents what that pharmacy would generate as earnings if a new owner would walk in there tomorrow and start running it. So to run through a quick example of what that might look like, here's a profit and loss statement, and the actual column is what generally has been received from the vendor. You would then go through line by line to have a look to see, okay, does anything need to be adjusted? Are there anything there that won't be there on an ongoing basis? So if we look down, cash flow boost, okay, that was a one-off non-recurring government incentive. That's not going to be part of our FME. We said before that depreciation is not included because your value of your plant and equipment is already included in the value of the pharmacy. Donations, you would argue that they're not required as an operating expense for the pharmacy, they're more a discretionary expense. Interest costs, well, that's specific to the owner and how they finance the business. Legal fees are generally one-off and non-recurring. Motor vehicles is always a good one to have a look at because quite often the owners might run their own private vehicles through there. But there may be cases where the motor vehicles is fine to stay because it's really the cost of running a delivery vehicle for the pharmacy. Rent, you'd have a look to see that, okay, does that actually match back to the lease? And then you'd have a look at the wages and the superannuation. One, does it match the roster? And two, has everything been included? Quite often, if an owner's working in the business, they may not be paying themselves an actual wage. So in this instance here, when they reviewed the roster, the owner's wages weren't included in there, so they've made an adjustment to include that. As you can see, the future maintainable earnings of 255,000 is different to the profit and loss of the 309,000 that was on the face of the P&L, and it's the FME amount that is then used in the calculation for determining the value. So once you've worked out the FME, the next part is to determine the capitalisation rate. Now, the capitalisation rate, or quite often referred to as cap rate, represents the return on the investment that is required by the investor. It considers the risks and opportunities that are inherent in the business. Now, usually the cap rate is around 15 to 17% for metro located pharmacies and 18 to 20% for rural pharmacies. It can be higher than 20% for some of those really remote pharmacies as well. Now, it's important to note that the lower the cap rate will result in a higher value of the pharmacy, and a higher cap rate will result in a lower value. So factors that impact the cap rate, as I mentioned before, the location being metro or rural, but also the location, if it's metro, is it in a CBD? Is it in a major shopping centre? Is it in a strip mall location? Is it in a medical centre? They'll all have a play on the cap rate. Also, the competitors, how many are around? How close are they? How big are they? The lease, how long's left on the lease? What annual increases or rent increases are there in the lease? Also have a look at the consistency of the sales. Have the sales and the gross profit, the future maintainable earnings, has that been consistent over the last few years, or has it jumped around, increased, gone up, gone down due to varying circumstances? It's also important to consider the source of the sales. Now, some pharmacies may have a heavy reliance on nursing home contracts. So you would then need to have a look at those contracts to see how long's left on them, when are they expiring, what is the likelihood that they'll be renewed, because that may have an impact on the sales and the profit being generated going forward. And lastly, also the reliability and the integrity of the information that's provided. If you only ever provided management type accounts from the vendor as opposed to accounts that have been signed off by an external accountant and had a tax return lodged with them, that plays a part as well in determining the cap rate. So once you've determined the FME and the cap rate, to then get to the value, it's a simple equation of dividing the FME by the cap rate. So in our example, we had an FME of 255,000 and we've assessed the cap rate to be 17%. That equates to a value of $1.5 million. Now, just remember that value is comprised of the stock, the plant and equipment, and the goodwill. Chris, have we got any questions on valuations before I move on to due diligence?
Yeah, there's always questions around cap rate, Rob. So everyone's always very interested in cap rates. So are you seeing cap rates increasing or decreasing?
We've seen cap rates decreasing, especially over the last 12 to 18 months. A couple of reasons for that is, one, the cost of capital, the cost of sourcing finance from the bank is as low as it's ever been. Andy could probably talk to this, but there's financing available out there. You might be able to get lower than 3% on a business loan, which is just fantastic. Another reason is really the stability of the pharmacy industry over the last 18 months, where we've seen a lot of retail businesses being very susceptible to lockdown restrictions through COVID. Pharmacies really held strong, with the exception of the CBD and major shopping centre pharmacies, where they just haven't had the foot traffic going through. The suburban community pharmacies have really held up over the period, and that's attractive for buyers.
And do you think valuers are going to start to reduce their assessed cap rates based on some of the purchase prices?
Yes, I think so. I know in Brisbane here, where 12 to 18 months ago, your run-of-the-mill community pharmacy may have had an assessed cap rate of 17%. That's now down into the 16% now.
And a very common question we get is the valuations are very often lower than purchase prices. Why is that?
Two reasons. One is that imperfect market that we're seeing at the moment, where there are more buyers than sellers. So people are willing to pay more just to get in. And also, a buyer then may come along and they may see more value. They say, okay, look, I'm really good at service income. I can really improve the service income of this particular pharmacy. So I'm willing to pay more for it because I know the profit will be there in the future to support that value.
Okay. Before you kick on to the next section, sorry, I missed a question earlier, but in one of your previous slides, you had a couple of references to PPI. Can you just explain what PPI stands for?
The PPI, that's your pharmacy practice incentive income. So that's all the income that comes out of the 7 CPA. So things like your DAA fees, your home medicine reviews, meds checks, that type of income.
Okay, thanks. All right. That covers off the questions we've got for valuations and cap rates. So back to you.
All right, so due diligence. Now, the process for due diligence, and Jack has sort of touched on this on the order and how it works. But before you go to contract or before you go to heads of agreement, you obtain enough information, generally from the broker, to make an offer. And if it's accepted, then you go to contract or heads of agreement. Contract or heads of agreement is then usually subject to the due diligence and the finance. So the next period is typically a 14 to 30-day period to conduct the due diligence. And it's a process of conducting a more detailed review and analysis of any or all of the information required to satisfy a purchaser that the contracted offer remains appropriate for the circumstances. So this is where you do your homework. You request any additional information that you haven't been provided in the broker report, and you or your accountant really does a thorough check through it. So when we perform a due diligence, some of the information that we will request will generally be for like the past 3 financial years. We'll ask for the financial statements. Also have a look at the income tax returns and check that what's being recorded on the financial statements matches what's actually being declared in the tax return. We'll have a look at the business activity statements. Do they match back to the tax return and the financial statements? We'll look at the script analysis reports. We'll look at the POS reports. We'll check the stock on hand. Is that matching back to what's being reported on the financial statements? Have a look at the wage reports. Does the payment summaries that's been provided to the tax office, does that match what's been put in the tax return and the financial statements? It's also important to have a look at, say, a top doctors report to see where all your scripts are coming from and whether those doctors are still around and still in the area. We'll have a look at wholesaler reports, the statements from the wholesalers, and importantly, we'll have a look through the lease as well. Chris, any on that?
Cost. What does it cost to get a due diligence report compiled?
For a full financial due diligence, we would charge around $3,000 to $4,000 plus GST.
And then if you find something in there that you're not satisfied with as a result of the due diligence?
Yep, that's when you can then go back to the vendor or the broker, drill down further, ask for more information. If you're still not satisfied once they've been provided and answered all your queries, that's when you go back to your solicitor and you make a call to say, okay, I'm either happy to proceed or I'm not happy to proceed based on that information.
And do you think it's always necessary to get a DD completed?
Look, it's always a good idea, but it really depends on the size and the risk of what you're purchasing. If you're purchasing a small regional pharmacy for a few $100,000 and you've already prepared a valuation, then you may just have your accountant have a look at a couple of other things as well. You've probably got a fair idea of what you're buying in that business. But say if you're spending $1 to $2+ million on a pharmacy, then yes, I definitely would recommend you get a due diligence done, just to do your homework and make sure you're comfortable with what you're buying.
Okay, great.
All right, and lastly, just the financial forecasts, mainly cash flows and budgets. Now, a budget's a month-by-month detailed summary of the expected income and expenses of a pharmacy or any type of business, really. It incorporates seasonal trends, expected growth, any CPI increases for expenses, etc., and also any rent increases. Now, the budget may be relevant for your finance application, and a bank may request a 3-year budget as a part of your application. If they don't, it's still a useful tool to have in tracking the business performance in a timely manner. You don't want 12 months to go past and then you get to the end of the financial year and then you start reviewing how your business has performed. You want to be tracking that on a month-by-month basis. Then you have your cash flow, which is a summary of the actual cash inflows and outflows of the business. So it incorporates the cash that's going to be generated from the budget that you prepared, but it also then incorporates any non-expense type items that aren't recorded directly through your profit and loss statement, which is your tax payments, your principal debt repayments, and any drawings or dividends that are being paid to the owner. Now, the cash flow statement is beneficial in highlighting times where there may be insufficient cash throughout the year because of the timing of some of these tax or debt repayments. So it's a really good planning tool to have once you're in the pharmacy and beginning to operate it.